G'day and welcome to this week's video. My name's Robert Gowdy, and this week we're going to have a look at market volatility and discuss whether this is actually risk. So a big part of what we see on the day-to-day fluctuations of the market is volatility. And does this mean, is this a risk to investors over the longer term? My argument is that it's not, but let's have a quick look at what does financial risk mean first, and that is, in my view, the permanent loss of capital. And as Warren Buffett puts it, probably his number one rule is, rule number one, do not lose your capital, and rule number two, do not forget rule number one. So fair call, just don't lose your money. So if we have a look at what market volatility is, and as I've discussed here, I think market volatility is opportunity, and it's simply the variations in the prices that people are prepared to pay, both up and down, over a particular period of time. Now, volatility, where the market is fluctuating on a daily basis, is a very normal part of the markets. They're very liquid. It means they're trading all day, every working day at least. So that liquidity means that there's going to be ebbs and flows, determined by obviously what Trump tweets. Have made a comment there. In the past, he's made some outlandish comments on Twitter, and there the market has dropped up to 3%. So that's volatility. That doesn't mean that Microsoft or Google or CSL have done anything different in running their business. Just because Trump has done a tweet that has spooked the market, they've still got their eye on the prize in terms of developing superior products and services to their clients. So that is pure market volatility. The whole market fluctuates with these type of movements, I think that's it's not a risk. It is more opportunity than anything else. How do we spot market volatility? Well, I think the best source to be able to spot market volatility is just watch the media. The media will let you know when the news turns bad. Of course, the media loves that, and they're going to pump up this bad news because bad news sells. So that's your alarm bell. They often say that no one's going to ring the bell or the bottom of the the top of a share market, or the bottom of the share market in a bear case scenario. No one's going to ring the bell, but the media can be some type of bell for you, particularly on the downside, because they're going to report the bad news more so than the good news. So what does risk look like in my view? And that is more so at the business level. So business risk, that can mean a capital loss. So where a business comes out and they issue a profit warning and say, look, we don't expect our profit to be the $10 million we hoped it was, it's now going to be $7. And then they come out with another profit warning. And I've put that second point there because quite often we see bad news tends to breed bad news in a company. So quite often having frequent profit warnings over a year happens quite a lot, because for some reason fundamentals have changed, commodity prices have come down, and they're forever out there revising what they think they'll make for the year. And this is where you can see significant price drops of 20% negative or more. So that can happen very easily. I see that as business risk, and that is real risk where you can lose capital, where you just get a call wrong. Of course, another option is where we have business risk is where the business's model, their services, their products have been disrupted, and obviously that's been the video store, CDs, all these different book retailers. While some of them are still going, but it's not the business model it was. There's so many different ways to deliver the content that used to happen physically. Now it's a lot harder to pick at the business level, rather than general volatility. The media will report on that quite easy for you. They'll tell you when the news is bad, but when a business goes bad, you're often you've really got to watch closely. You've got to read the reports, so it's much harder to pick. Sometimes going with your gut, where your market business goes down, if there has been profit warnings and issues with the business, that's probably a warning sign. And as I said, bad news often breeds bad news. So that's just my please try to separate general volatility in the market, which is completely normal and provides us opportunity. It can be our friend. And I used to be dark on the media for overplaying the bad news, but now I'm actually pleased they do, because that makes people a hell of a lot more scared than what they would be, and that forces people to make irrational decisions, which is sell. And guess who'll be there trying to buy as much as you can when the news is bad? That'll be myself and my clients. But at the business level, obviously much harder to pick, but that's where you've got to read what the CEOs are saying, see if it's in line with what they said previously, and if it's a profit downgrade, sometimes you've got to cut your losses, make a call and say you got it wrong and move on. Thanks for listening. Please subscribe to the channel if you already haven't, but those who have, thank you very much for your support. It's a very small channel, but we appreciate that those have clicked the subscribe button, and we'll catch you next week. Thanks for listening.